The cost of capital is the rate of return a company must earn on its investments to meet the expectations of its investors and lenders. It's a crucial metric for businesses to determine whether a project or investment is worth pursuing, as it represents the minimum return required to satisfy both equity and debt providers. The cost of capital has two main components: the cost of equity and the cost of debt. The cost of equity is the return shareholders expect for investing in the company. Since equity investments carry higher risk than debt, the cost of equity is usually higher. For example, if shareholders expect a 10% annual return on their investment, the cost of equity is 10%. It is often calculated using models like the Capital Asset Pricing Model, CAPM, which considers factors like market risk and the risk-free rate. The cost of debt is the interest a company pays on borrowed funds, such as loans or bonds. For instance, if a company borrows at an interest rate of 5%, the cost of debt is 5%. However, because interest is tax-deductible, the after-tax cost of debt is lower. For example, with a corporate tax rate of 20%, the after-tax cost of debt on a 5% loan is 4%, 5% times 1 to 0.20. To evaluate its overall cost of funding, a company uses the weighted average cost of capital, WACC, which combines the cost of equity and the after-tax cost of debt based on their proportions in the capital structure. The formula is WACC equals E/V times RE plus D/V times RD times 1TC, where E is the value of equity, D is the value of debt, V is the total capital, E plus D. RE is the cost of equity, RD is the cost of debt, and TC is the corporate tax rate. For example, if a company has 60% equity with a cost of 10% and 40% debt with an after-tax cost of 4%, its WACC is 7.6%, 0.6 by 10% plus 0.4 by 4%. This means the company must earn at least 7.6% on its investments to satisfy both equity and debt providers. The cost of capital acts as a benchmark for evaluating investments. If a project's return exceeds the cost of capital, it creates value for the company. Conversely, if the return is lower, it could destroy value. For example, if a company's WACC is 8%, but a project is expected to return only 6%, the project would not be financially viable. In summary, the cost of capital is the minimum return a company needs to earn on its investments to cover its funding costs. It's a vital tool for assessing project viability, maximizing shareholder value, and ensuring efficient allocation of resources.